Most people will spend the next 10 years working hard, spending what they earn, and saving whatever is left over, which is usually nothing. And here is the uncomfortable part. They will do this while telling themselves they are being responsible, that they are managing their money, that one day, when the time is right, they will start investing. The time never gets right. But there is a small group of people who made a different decision. Not a dramatic one, not a rich person decision. They started investing a little bit of money every single day for 10 years straight. And what happened to them is not what most financial advice channels will tell you. It is more interesting, and in some ways, more unsettling. This is what actually happens step by step. Let us start with a number, $5 a day. That is not a typo, $5, the cost of a medium coffee in most cities. If you invested $5 every single day into a broad market index fund, something that tracks the S&P 500, for example, and you did that every day for 10 years, you would have contributed roughly $18,000 of your own money. $18,000 sounds modest, nothing world-changing. But here is where it gets strange. Depending on when those 10 years occurred, your $18,000 would have grown to somewhere between $35,000 and $60,000. In some decades, considerably more. You did not get rich, but you did something most people will never do. You made money without working for it. That is the mechanism. That is the thing everyone talks about when they say compound interest, but never explains clearly enough to feel real. So let us make it feel real. Here is how it actually works from the first day to the last. Day 1. You invest $5. It buys a fraction of a fund. That fund is a tiny slice of hundreds of companies. Your $5 is now exposed to the economy. It moves with the market, up some days, down others. Nothing dramatic happens yet. Month 1. You've put in about $150. The market has moved. Maybe your position is worth $148. You're down $2. You feel nothing. Month 6. You have put in roughly $900. The market has had a correction. Your account reads $780. This is the first psychological test. Most people get here and think they made a mistake. Some of them stop. The ones who do not stop are about to see something interesting. Year 1. You have contributed roughly $1,800. If markets behaved roughly as they have historically, your account is somewhere near $2,000. You made $200 you did not work for. It doesn't feel like anything yet. Year 3. You have put in about $5,400. Your account, assuming roughly average market returns, is around $6,800. The gap between what you put in and what you have is now over $1,000. It has started to pull away from you. Year 5. $11,000 contributed, account value approaching $15,000 or $16,000. You have made $4,000 or $5,000 without lifting a finger. Now it starts to feel something. Year 8. About $14,600 contributed, account value somewhere near $22,000 to $25,000. You have made roughly $10,000 on top of what you put in. Year 10. $18,250 invested, account somewhere between $35,000 and $55,000 depending heavily on market conditions during your specific decade. The money you made without working is now roughly equal to or greater than the money you actually put in. That crossover point is the whole game. Now here is the part financial influencers skip past. Those numbers assume average returns, roughly 7 to 10% annually adjusted for inflation, which is approximately what the S&P 500 has returned over long periods of history. But history is not a guarantee, it is a pattern. The Japanese stock market in 1989 was at its all-time high. Investors who started putting money in every day that year waited 25 years before they were back to even. 25 years of daily investing with a daily discipline no one would question, and they were flat. Not ruined, flat. The math of compounding only works consistently in one direction, growing markets. If the market you are invested in stagnates, compounds slowly, or collapses, your 10 years of daily investing can produce results that range from underwhelming to genuinely painful. This does not mean the strategy is wrong. It means the strategy is not magic. It is a bet. A well-structured, historically well-supported bet, but a bet. Now let us zoom out, because the individual math is only half the story. When you invest every day, you are doing something called dollar cost averaging. You are buying at every price, high prices in bull markets, low prices in crashes. Over 10 years, your average purchase price ends up somewhere in the middle of all those extremes. This is the quiet genius of daily investing. You are not trying to time anything. You are not guessing when to jump in. You are taking the question of when completely off the table. In 2008, when markets fell over 50%, daily investors who kept going were buying shares at half price for 18 months straight. By 2013, those discounted shares had not just recovered, they had compounded. The crash, which felt like destruction, turned out to be the most important buying period of that decade. You only capture that benefit if you keep investing when it feels terrible, and it does feel terrible. There is nothing comfortable about watching your account drop 15% while you keep adding money. This is the hidden cost that nobody puts on a compound interest calculator, the psychological cost. The months where you wonder if you misread the world, where your friends think you're being reckless, where the headlines confirm every fear you have. The math is simple, the behavior is not. Let us talk about what 10 years actually builds. If you scale the $5 a day up to something more aggressive, say $20 or $50 a day, the numbers change substantially. $50 a day for 10 years is roughly $182,000 contributed. At historical average returns, that account could be worth somewhere between $250,000 and $350,000. That is not retirement, but depending on where you live, that is optionality. The ability to take a risk on a business, to take a year away from work, to weather a crisis without panic. The real product of daily investing over 10 years is not a number. It is a different relationship with financial time. Most people live financially in the present tense. Daily investors, almost by accident, start living in the future tense. They start thinking in decades instead of months. They stop reacting to headlines, not because they become wise, but because they have built something that requires them to stay calm to protect it. There is one more mechanism worth understanding, and it is the one that becomes most important in years 7, 8, 9. It is called the snowball effect, but not the metaphor version, the literal math of it. In year 1 of daily investing, you earn returns on what you contributed that year, maybe $200 in gains. In year 5, you earn returns on everything you contributed in years 1 through 5, plus all the gains those years generated. The base is larger, the returns are larger. In year 10, you earn returns on a decade of contributions and a decade of compounded gains. The amount you make in year 10 in a good market year can be more than everything you made in years 1 through 5 combined. This is why people who start 10 years later, even if they invest more aggressively, often cannot catch up. The early years look unimpressive. The late years are where the structure reveals itself. The first 5 years feel like you are building nothing. You are actually building the engine. So, here's where this lands. The mechanics of daily investing are not complicated. Buy something, repeat, wait. The history of it is reasonably encouraging. The psychology of it is genuinely difficult. The outcomes are real but not certain. What is certain is this. The people who spent the last 10 years doing nothing with their money are now 10 years older with 10 years less time for compounding to work. That window closes, not dramatically, not all at once, just quietly, incrementally, every day they wait. The uncomfortable question is not whether daily investing works. Historically, it tends to. The question is, what are you actually waiting for? Because in 10 years, you will either have an answer you are proud of, or you will be asking yourself the same question again, with a decade less to work with.